Excellent. Glad to hear it. Thank you. Reed's going to get the door. He's also going to eat his, I don't know if this is his Italian sandwich or what, but that way people can stay entertained and engaged in the webinar. They don't have to watch the slides. They can just watch him eat a sandwich.
Awesome. I'm good.
All right, cool. Well, I guess we already have a number of folks in here. So Nicole left us, but Reed, you and I can get started on this.
Yeah, let's do it.
All right, so we've done, oh, that's an old slide. Well, this is a really old slide, but we did our first webinar on this back in March, and now we had done weekly webinars for a while, and then this is, now we're doing them once a month through the rest of COVID. So this will have data up through, I believe, the 22nd, and on most of the slides, there are a couple dates that are not up to the 22nd, but we'll point those out as we get there. Come on. All right, so let's talk about industry impact. So for those that haven't joined this webinar before or haven't seen this data before, we'll just help hit some of these quickly. But what you see here is this is all all states in the US, it's multifamily inventory. This dotted line is when COVID really hit the US, and this blue line is representing the available units. And so you'll see, like, right after COVID, there wasn't a lot of impact those first couple of weeks, but then a lot of available units came online. And this is the really positive story, is that even though there are more new builds that are actually opening now, you'll see the available inventory has been on this just downward slope through the busy season. So people are leasing out. Yeah,
and this industry has been known to be on some level recession proof. Obviously, there's always winners and losers, and that's something I'm sure we'll talk about a little bit more, specifically like the classes. So you don't see this broken out as far as, you know, what does that inventory picture look like for A assets versus B versus C. And I'm sure several of the folks that are on the webinar and have been keeping up with this have followed that and noticed that there certainly are some trends unfolding there. But this is, as David said, a macro view. The best part of it, though, and he touched on this, is just how much new construction has hit the industry in 2020. I think it's at an all-time high, like 2x what it was even in 19, which is also a ton of new construction. And yet you're still seeing, as you see on that last bullet, but those two lines, that available inventory is actually below where it was pre-COVID, which is a really encouraging signs. But certainly I know there's a lot of questions, or would be, underneath that from a geographic standpoint to, you know, the type of assets that we're looking at. So we can get at those, and we've said that before. If you have specific questions related to, you know, a certain geography or a certain asset type and the like, then just get those to us, and we'll do what we can to get you a response.
Yeah, good point. If you guys have questions, you can drop them in the Q&A section of the webinar, and then we'll just we'll hit those for what information we have on demand. We'll hit this at the end of it. Otherwise, we'll follow up with you via email. But to get to the geography, some of the geography, we'll hit this next slide. So what this slide is doing is this is hitting, this is talking about absorption rates, and absorption rates against you'll see the blue line is lower COVID markets, the orange is higher case COVID markets, and then you'll see Florida and Texas broken out, since those are some of the markets that have been impacted more recently. And so again, we have the COVID line hitting, and when we first showed this back in March, there was some large variation between high COVID and low COVID states. And then you'll see here towards the end of March, this is what our data team called me is basically the range. The range of what's happening. So some of those lowercase states were super impacted in March, even though they were lowercase states. But anyways, what my overall point that I'm getting to is, you can see absorption is starting to trend up, of course, because availability is going down. But even the highly impacted markets are actually trending similar to the low markets at this time. Although in this past week you have seen some separation. So some of the surprisingly, some of the low case markets are actually not absorbing as well as some of the high markets like Florida, for example.
Yeah, and I think great insight here, last bullet, on the recent divergence between lower and higher case states may reflect relative reopening. So all that's to say is that some of these higher case states are actually showing better absorption rates, and that speaks to, on some level, you know, this is just a hypothesis, but to to the reopening. Because certainly it is harder to get things leased up in a virtual world, although it seems like the industry was starting to acclimate pretty well, and now there's a bit of a new norm, you could say. But because of that, being quicker to reopen and relax some of those restrictions, I think there was more people out leasing in Florida and Texas. Unfortunately, that again aligns with also where we're seeing spikes in cases. But the other second to last bullet, I think, is also good to see is that the seasonality, that frankly the industry counts on is still there. Meaning, this is leasing season. Shouldn't we expect to see a spike? And that's in fact exactly what's happening. So good to know that some of the trends that everyone relies on are still playing out.
Cool. So how does all of this impact your folks' marketing? So this one I thought has gotten really fun over time, but I know now there's a lot going on because we have so much data and there's so many colors. But so this green line that you'll see, that's apartments for rent across the US. And then this is the range of how different markets are impacted. So there's quite a range depending on your market. So as Reed was saying, depending on your geography, you're impacted differently. But I'll generalize some of this and then we'll talk about some of the markets independently. This blue line is 1 year ago. So this is showing year over year. And so year over year, you can see we started the year with this year being a much higher intent year overall for people looking for apartments. And then once, right after COVID really hit and impacted, you'll see that there was a 20 to 25% drop across the US as far as people searching for apartments. But then in April, we actually crossed over and had higher search volume across the US for apartments than what we had last year. And you'll see now, we're actually in this last week, even with what last year was, but if you look at the week prior to last, you'll still see that this year was a higher search volume than last year. So again, all of these are positive signs when it comes to the apartment rental market. Then we have this overlaid with data such as the awareness for coronavirus and how that's been impacted, and you've seen that gone down, and unemployment searches. So this is really interesting to me as unemployment spiked right after COVID, and we keep hearing about these unfortunate unemployment numbers, but you'll see that they're slowly on their way down as far as how people are searching for unemployment. And these wide variations, those are the weekends. So people stop looking for employment on the weekends, and they really spend it during the weekdays. It's when they're doing those unemployment searches.
Yeah, so definitely positive. Getting back to, I guess, kind of what's underneath this, and where we welcome again questions, requests for some of this data, and a lot of it's available through Fiona, our marketing platform. But what does it look like at a floor plan level when you're seeing these types of searches? So the macro search volume is what you guys see here, and we take that, and hopefully everybody does, is just demand. But then at a floor plan level, just like that we were talking about A, B, and C's, like kind of who's winning and losing, how that's shaking out. In fact, in one of our calls this morning, we were hearing about that from a client in Florida, just saying that 2 bedrooms are really spiking, and partly because people are actually moving in with each other. And then there's other cases, of course, of folks downsizing. And then you have the inverse or the single family real estate impact, which is some people are having to move out of their homes and into apartments. So all that is underneath this data, but this gives a good picture, obviously, of what's up top. Super fascinating.
Just to piggyback on that from the conversation this morning, but there are also certain markets that we've seen where 3 bedrooms have spiked, which I found really interesting, because generally this is 3-bedroom season is just when school's out, which is certainly now. But as you said, if people are moving out of studios and 1-bedrooms to find roommate situations to help them financially, then you may actually see 3-bedroom activity and leasing season go into the fall, which is usually your SOL once you hit fall if you have a 3-bedroom.
Totally. Great point.
All right, so this is actually this is a new slide. I hadn't seen this one yet.
There you go. I teed us up without even knowing it. This is some of the floor plan level insights. It's still not distilled down, and nor could it be really to every market or anything, or every state. But yeah, this actually gives you a picture by floor plan, what the trends look like. And I think this is good, again, at a macro level, but far more valuable for people, to see what's happening at their market.
That is super cool. If you see how studios hit their peak right before COVID,
Yeah.
and they took a major dip, but some of them are correct, have been slightly correcting. But obviously, as you see this 3-bedroom, Reed, it's not quite, but you know it's close to my parabola.
Yeah, and then there's the luxury, right? So back to, you know, how are the A's perform versus the B's and the C's? That's also got to be good news as far as seeing a little bit of an uptick or rebound after a pretty precipitous fall that really started at the beginning of the year, funny enough, before COVID even hit, but then it just got worse. So good to see that number coming back up.
Super interesting, because all of the clients that I've been speaking to have been just nervous about their luxury units not being able to move them.
Right.
So it's almost like at least the data is different than what people are perceiving right now, because having 80% of your of an index is pretty high. So to your point, like luxury is still, I mean, it's still moving.
Yep.
All right, so this is campaign performance, and this is previously was one of the best news slides that we had. But you'll see here, this orange is this year cost per click data versus the blue is last year cost per click data. And right after COVID, there was a major spike in cost per clicks where they had just skyrocketed. And our, sort of word tracking there is what we expect happened is that this was kind of in that first month after COVID really hit. And so search activity you had seen really drop through the floor, but yet people hadn't yet pulled their advertising dollars. Then moving into April, people really pulled out their advertising dollars, and yet the search volume started to increase. And so you'll see the cost per click started to come really down. In fact, to where now it's not that far off from year over year. It's just 10% higher. I guess we're doing the math here. It's 9% higher now than it was last year, which all things being considered, I think is actually really good news. And in particular, one thing we had brought up before was apartments.com had announced they were spending $100 million more in search this year than last year. Now, I don't know if they changed that plan after COVID hit, but at least when I last looked at the data, they were still spending pretty heavily.
Yeah, and it's common for them to come in heavy in March. Naturally, they're aligning with leasing season, and so several of the other atlases did. And I don't think by any stretch they single-handedly responsible for that big uptick. I think you hit it on the head as far as the lower search volume. But it wouldn't surprise me as we try to forecast a little bit, and you see somewhat of an uptick year over year here at the last few weeks, is that things are getting more competitive. We certainly have experienced that, with all the new construction and with the economic crisis and COVID still very much affecting the country. That it's not going to be as easy to come by leads. Therefore, that could potentially drive up that cost per click or continue to drive it up in the next couple of months. So we'll keep a close eye on that. Again, some markets are far more competitive than others based on all sorts of market conditions, inventory trends, and things like that.
All right, so this graph, if you guys had seen the earlier webinars, actually hasn't changed that much. But what this is showing is before COVID and after COVID. And it's trying to say, well, where are people coming to your website from? Like, what are the referral sources? And the biggest change that we had seen is this other category, of course, but that one is more, we believe, a relation to how Google is tracking referral sources into analytics now. So we're ignoring that category. But paid social is actually where we're seeing the biggest impact in a positive way. More people are spending time, it seems, on the social platforms, and thus, if you're running social advertising, you have there's more of a chance that you're going to capture their attention now because they're bored, and then they go to your website. The other thing we've seen, and we'll get into this later, but we've seen that dollar for dollar, you reach more people now on social than you had before COVID. So you're basically, you have a greater, it's more cost effective than it was before. The other note I'll make here is, before passing the read, is organic search has taken a hit, which I thought was super interesting because we saw that search volume came back to where it was of last year. And so you would imagine that people, that you would be found through organic search, but in fact, we're seeing it's just not representative of, and so I don't have a theory around that. If it's like, have rankings changed for websites over time versus this year versus last year? Has some other player come in and started sucking in the traffic from organic compared to what people were getting before?
Yeah, I mean, it shouldn't be too affected, but it could be affected, by the amount of spend coming in right now. Certainly, like I said, over the last 2 or 3 months, you know, where there's just so much advertising being poured in that that organic is not getting the same kind of results or traction they did before. That being said, footnote is this is not, just to be clear, a year-over-year picture. This is showing, you know, what was happening just more pre-COVID. So you have to factor seasonality into this a little bit, if not a lot. And then on that social, if you also look at display and even email, this speaks to the whole middle metrics. And, you know, for those that know me and David, we talk about it quite a bit. But that kind of the casual, you could say buyer, you know, maybe isn't at the bottom of the funnel. Those platforms or channels that support that really spiked because frankly, everyone's spending more time on their devices, on their computers. And there's some great, I guess, research, you know, that highlighted that just about the number of hours that are being spent on digital devices since COVID hit, which is a no-brainer. So therefore, a good opportunity, I would say, for a lot of marketers and properties to put more focus on those middle metrics, if you will, kind of in the consideration phase. So really put a priority on your branding right now because people are more inclined, as the data speaks for itself, to engage with that. So don't ignore that and get caught up in, you know, just an ILS paid search strategy because you're missing an opportunity.
Okay, so what we're showing here is, okay, so people are coming to our website now, but is it quality traffic that's coming in? And so this y-axis is related to time on site versus against timeline of day. And the blue is high COVID markets again versus orange is low COVID markets. And of course, we have the whiskers here on how wide the range is. So if you look at it, high COVID markets took the biggest hit right after COVID as far as people coming to the website has dropped significantly. They just were not spending as much time, but it started to get close to pre-COVID levels. Although what I find really fun about this whole graph is look at the variability in like the highs and the lows of both of these and how tight it has gotten now. It's like all users are spending about the same amount of time on a website if you're high COVID, and then all users in low COVID market are spending about the same amount of time on a website. Low COVID has actually seen, in fact, almost basically like an upward trend of time on site versus before. So I don't know if you have anything to add here.
No, I think it's a great call out on the variability starting to contract. So there's more stabilization, and I'll just say unfortunate, but somewhat predictable, you know, with people in those higher case estates not able to or wanting to spend as much time, you know, on a property's website as those that are less affected. So almost gives you sentiment or psyche, you know, right, at a high level. But then, you know, what does that look like by market? Yeah, it's really interesting, or would be.
Okay, so this is one of those few graphs where we don't have data into June, but I'm going to hit it anyway. So people are coming to your site and they're spending more time on site than they were before, but what pages are they viewing? That's what this graph is getting at. And this one is about a month old. They're, frankly, there's just a problem with the Google API giving us the same level of granularity of data that they were giving us back then. So we're working on fixing that. But in the meantime, we wanted to hit this slide because we thought it was important. So you'll see this is the higher converting pages for prospects: floor plan page, availability page, amenity page, contact page. If you're a current resident, you don't need to go to the amenity page, or you don't need to go to the availability page of a website. And so what we wanted to see is the traffic that's coming to a website, are they current residents or are they not? And based on this trend line, this upward trend line, we believe not. So the traffic that's coming to a website is more likely a prospect now than it was before because they're spending more time on these higher converting pages for prospects.
Yeah, and this one doesn't perfectly lay on top, but it's not far off from what we showed at the beginning, which was the absorption rate and the availability, right? That tells you that, you know, inventory is moving again. Therefore, you should expect these page views within your Google Analytics to see a similar trend, meaning positive, and that's translating into units actually moving. So just ties well to where we started.
Okay, so this is campaign performance data, and again, I know a lot's going on here, so we'll quickly walk through. But the teal is the clicks from pay-per-click campaigns. The orange is the average number of leads generated from those clicks, and thus the line I believe you guys should really care about is this gray line, which is click-to-lead ratio. Now, this was a super positive story right after COVID, where we were saying, hey, the good news here is the people that are coming to your site are far more engaged and they're high quality traffic visitors than they were before. But then you see this terrible thing that started to happen in May, where we just fell off a cliff on click to lead ratio, and your click to lead ratio is not near what it was directly post COVID. And we don't have this for prior years. So to Reed's point, like seasonality matters a lot. But now the traffic that's coming to the website is just not converting as high as it was before, at least online conversions. So online conversions being form fills, phone calls, things like that, well, we're not capturing as walk-ins. So to Reed's point, like in markets that now people feel the freedom to walk into a property instead of call a property to schedule an appointment, that's not being captured. The other thing that's not being captured is many of the virtual tour technologies don't have great conversion points for us to gather either. So if properties have done something on the website that have set up virtual tours, we're also, and someone's like going straight through that process to do their leasing, we're not capturing all of that either. And so that could be muddying the data here, since a lot of folks moved to online tours in May.
Yeah, I think you hit it well, touched on some important points. It's not a coincidence to me when you think about the reopening that's when you start to see things tail off. So immediately you're going to see a downward turn or downturn based on that fact, and that people are actually able to get out there and start leasing in person and do their normal kind of drive-bys and walk-ins. The other, again, just hypothesis here though, is with all the new units, as well as the competition, that's going to dilute the leads, meaning, the conversions. So it's like all these units that have opened up and now people have more freedom to, I guess, get looks at them, that how can you expect to have the same lead to or click to lead conversion as you did before? You're automatically dealing with a lot more competition, not to mention how much more money is being spent kind of collectively in the industry.
The other thing, back to your hypothesis, is we hear a lot of folks are shopping now. So when pre-COVID, it was like, it's not prime leasing season. If you're looking for an apartment, you need an apartment. And then right after COVID hit, everyone was locked down. And so if they had to move, and that's why they were looking for an apartment. They weren't just like browsing. They were like, I'm in lockdown, but I've got to move to wherever because I've got a new job. And then as now people are moving, a lot of properties are allowing these month-to-month extensions on leases. And so people aren't required to sign a hard year agreement or like decide that I want to stay here or not. And so back to hypothesis, I could definitely understand behavior where people are like, you know what, I'll do one more lease in this thing, but I'm going to take my time to look around and see where I might want to go next. In fact, you and I were just on a call 10 minutes before this where we were interviewing a candidate moving from New York, and she's in New Orleans now. Her apartment was left vacant in New York because she's like, everyone left, leave New York. And now she's like, I want to kill that apartment and move to Denver. And so I could see a lot of people kind of doing that sort of move where it's more back to research phase. Hey, I get to pick my shot because I'm not forced on this crazy timeline because I can do a month to month.
Yeah, and putting a cherry on that thought would be concessions. There's more and more conversation around that right now, but how is that affecting lead volume or conversion volume? And I would, again, speculate that, as more and more concessions are being promoted, that you're almost provoking them to search more. So instead of like, oh, there's a good deal, it's like now there's great deals and incentives everywhere they look. Mm-hmm. And so therefore, again, you're going to see some attrition on lead to or click to lead.
You usually put the cherry on. I never get to put the cherry on, but we actually have a client in the Bay Area where that's our suspicion, is that they're driving up concessions, and it's making people say, hey, well, what else is out there? And so they're like driving that conversation.
Yeah, I can get a better deal right now, so I don't want to be the sucker that just sees one month off rent and I go and sign a lease. I'm going to make sure that I look at all the deals.
Yeah, totally. Okay, so this is now moving to cost per lead, and this makes sense. If we're saying the click to lead ratio has decreased, then that would mean cost per lead has gone up. What's again interesting to this is this data goes beyond our client base, but with our client base, I haven't been seeing in the reports that their cost per lead has been doubling. I've seen actually pretty great cost per lead through May. So this is more of like an awareness thing. Again, this is limited by if you're doing online tours, that's not necessarily being captured, and some of those other things that we just hit in the other slide. But this is more just saying, take a look at your cost per lead. It may have jumped, and if it did, guess what? The industry as a whole is jumping right now as well.
Yep, and I think this is just another slide, and it's good to have these validation points or some consistency in the story the data is telling us, but I still feel competition and concessions are a big part of this, you know, and it isn't in every market, like you said, and some of this, you know, we'll just be open, is about execution too, you know, because what worked as far as campaign strategy, you know, more in the weeds stuff that we won't detail out, is not necessarily going to work, you know, today, like post-COVID. So the agencies that are managing these campaigns need to be more thoughtful, need to make sure they're pivoting accordingly based on how the, you know, what the data is telling them. But you know, if concessions are continuing to drive more people looking around, then your cost per lead is going to go up, not to mention all the new construction, new units that are out there in 2020. So not a surprise to me, but there are a lot of tactics that people, you know, can deploy, I feel like, to mitigate some of this.
Right. And if it is happening to you, back to your context, you can tell ownership like, hey, don't beat me up. What we've seen is across the board, cost per lead has basically doubled in May. And so if you're actually underneath double, you can actually call that a win, respectively, to your peers. Like, oh, I understand we went up 20%, but everyone else went up 100%. So, you know, let's celebrate right now.
Yep.
All right, this is call analytics data. So what we're showing here is that unique callers over the last 31 days has increased 61%. So it used to be that there was a lot of, or what we used to see in the pre-COVID, and even somewhat through COVID, we saw a lot of just constant, the same person calling back 2 or 3 times. And now we're seeing a lot more unique callers coming through, which I think is interesting. And you would hope that leads are increasing because of that. So just something to consider there. And then, yeah, and then we on 12,000 calls, we ran our AI to listen for references to COVID, and less than 1% of all calls mentioned COVID. So that's really interesting because back in the middle of in the middle of April, it was somewhere around 6% of calls were talking about COVID or coronavirus, things of that nature. And now it's fewer than 1% of calls. So it's basically fallen off the radar as something that people are really talking about.
Yeah, and I mean, when it relates to moving into an apartment, certainly it's still super active part of, you know, daily content that's hitting us. But I think the education kind of tsunami, and not to say that there aren't still things for us to be educated about the virus, but you know, that period is over. You know, like very few people, I hope, are saying, what is this and how does this affect me and what kind of, you know, precautions should I take? So it's not the lightning rod that it was before, and therefore if you were putting a priority either in your website copy or other ways to try and get out in front of that, maybe it's not as necessary as it was. And to the 61%, again, great consistency, validation on some of these other slides, but as you see, absorption rate, leasing trends, seasonality, and search volume all kind of up and to the right, and we're showing a positive trend. How can that not then result in more unique callers? You know, that means instead of a handful that are keep continuing to call you, that you're actually seeing now more diversification with your leads, which is a great sign.
All right, so what does this mean for your marketing strategy? So this, in this slide, what we're trying to show is how the different parts of the funnel have been impacted against their corresponding KPIs. And so we have, let's start with the upper funnel, which is the dark blue. That started at, you know, pre-COVID, it was in a really good spot. And now over time, it has really decreased in performance, but it has started to stabilize through May. Then you have, let's jump to your mid-funnel. Your mid-funnel took a big dip, but then we saw some really positive spikes. And even through now, which mid-funnel for us is going to encapsulate the paid social that Reed was hitting before. It's still performing respectively much better, consistently much better than it was in the prior period. And then I reversed that. Mid-funnel is the gray. Mid-funnel was doing really well, and then it fell off a cliff, but it's starting to rebound. It was the lower funnel that has had those sort of these variations. And some of these we wondered how much they matter by time of the month. So for example, you'll see this is at the end of April. You'll see this is towards the end of May, and this is towards, still kind of towards the end of May. we wondered that, this is something we haven't been able to answer, but the automotive industry, people will often hear me talk about, they get a much higher conversion rate at the end of the month versus any other time of the month. And I've wondered if apartments would see some similar cycle.
Yeah, well, and not to be a broken record, but yeah, you're seeing the lower funnel click-through rate spike right now, and it perfectly does overlay with the search volume as well as the absorption rate and inventory, available inventory that we're showing you. So leasing season is definitely in full form, and this is one more slide that proves that.
All right, so this is just looking at pre-COVID, post-COVID, about just standard click-through rate benchmarks that anyone on this call can be using to track performance of their campaigns. But what we're seeing is that these upper channel has taken a hit, about 25% down in post-COVID. But this is still a strong click-through rate for upper funnel. So that doesn't mean that you should get off of it. I'm just saying that it's come down about 25% to pre-COVID. You'll see here, though, this mid funnel that we were talking about, it's seen some roller coasters along the way, but overall it's averaging higher than it was pre-COVID. So that social advertising that Reed was hitting is still really impactful right now. And then here for paid search, you'll see that paid search click-through rate pre-COVID was strong, but it's gotten even stronger post-COVID. And I don't know, I think a lot of that has to probably go to seasonality as much as like the COVID situation.
Yeah. The message, hopefully not to be misconstrued here. When you look at this, I think one positive thing is it seems like the data is kind of normalizing a little bit. So while there are certainly some differences, maybe the most notable, respectively speaking, is search. But I think the most important part of this is looking at these holistically for each of your properties to see how one is influencing the other. Because the spike in click-through rate, on search can't be looked at in isolation. Most of the data that we're sharing with you is not singular or linear platforms, and so one is impacting the other, and that's your best bet to market smartly and optimize your campaigns appropriately. Is if I do ratchet up, based on some of the trends that I'm seeing or data, social, geofencing, and email, how does that then affect my click-through rate with search? And certainly that includes up top. So that's an important takeaway.
All right, so this is a new slide that Reed hasn't seen yet, but we were wondering how reviews had changed pre-COVID, post-COVID. And many folks on the call will probably remember that for a while, Google had shut off reviews when COVID first hit because they didn't want businesses to get slammed. But reviews are back on now where people can leave them. So we pulled year-over-year data here to see how reviews have been impacted. And it's the same property set year-over-year. Not a great story. You'll see positive reviews are down 46% year-over-year. Neutral reviews down 56%. Negative reviews, this is actually not supposed to be down. Negative reviews are actually up 67%. So
I assume the green should be positive arrows.
Yeah. Not a good thing. So basically, what I should have had this corrected ahead of time, but you're getting reviews now. But the reviews you're getting are not positive. If you're getting reviews, they're most likely negative. So people need to be really careful because it takes a long time for an apartment to build its reputation, particularly online. I constantly hear clients ask, how can we improve how many reviews we get? It's just so hard to get someone to want to review their apartment building unless they're already ticked off. And now you'll see we're 67% more likely to get a negative review now than we were last year. That's rough.
Super rough, but probably expected. The backlash, you could say, from residents that are not getting the flexibility that they're looking for, we're hoping. And certainly I think the industry stepped up in a big way. I mean, more often than not, we've heard just the opposite, at least from our clients, and what they're trying to do to find ways to accommodate folks that are under economic stress or financial stress. That being said, one of the takeaways for me on this is how important it is when you are doing right by the resident to make sure that you take that as an opportunity to ask for a positive review to offset what you can't really in many ways control, which is going to be a lot of angry people. The country is under all sorts of duress right now. So you should just expect that there's going to be more and more negative reviews, but you can't sit idle. And there are, like I said, a lot of great things, and I feel like gestures that are being made by the industry, and it's critical that those property managers capitalize on that when that happens and ask for a positive review.
Yeah, we in a way have to eat our own dog food on this one, meaning we had the same problem where, like, when times are really good, we don't ask for reviews, and then COVID hit, and it's not great, but we made it a company initiative to start asking our clients for reviews when we do something well, because it's not gravy out there right now. So if you do make an impact, please, you should be asking your clients to say something about it. And with residents, you can definitely be picky and choosy here. Like, it may not be perfect out there, but I know some properties that are opening their pool back up. And when I listen to calls and leads, a lot of the leads and stuff are like, is your pool open? Because this matters to me if we move here. And so if someone seems really happy about whether it's the pool or the cleaning product that you gave them or whatever, just take that chance now to try to, like, get every positive review you can get.
Totally. And it could sneak up on you pretty quickly with, I guess, the velocity of reviews. I don't know, I didn't capture that one, David, whether overall reviews are up. That would be interesting. And it would seem that's a distinct possibility. But what I mean by that is, if you're sitting, let's just say, comfortably at a 4-star, which is, a solid rating to have on Google, and then you look up 3 months later and suddenly you're at a 3.1, or, God forbid, underneath that, that's what you got to make sure you're watching out for, because if the volume keeps pouring in, those numbers can change pretty quickly. And just final point on that, at 3 stars, and we've seen it with our own data, and there's lots of supporting data, but there's almost a psychological tipping point. If you fall below 3 stars, that is not a good look on your GMB post or your GMB profile or your reviews. And so if you were sitting somewhere in the low 3s or mid 3s, I would keep a super close look on your reputation right now.
I don't have the exact year-over-year number, but pre-COVID to when reviews came back on after COVID, there was a major spike in the velocity of the reviews you were getting. So I don't know year-over-year, but pre-COVID to when reviews came back on, it did go significantly up.
Makes sense.
Oh, all right. Well, we got actually through those pretty quickly. So what's next for us? We actually, this week was originally NAA week. And so kind of tongue in cheek here, since NAA got moved, we thought it would be a fun week to push out a lot of content. So this week we're kicking it off obviously with this webinar, but then we have 2 really fun podcasts that we're releasing, I guess it's Thursday and Friday of this week. Shoot, I'm trying to remember who we had. Oh, we had Dennis. Dennis on from Joshua Tree Conference Group, who normally puts on AIM and MTech and some of those events, and his events got canceled, and so we wanted to talk to him and see how events have been changed now and forever, and what Joshua Tree is doing differently in 2020 in spite of this, and then what their plans are next year, what that means for them. And then
it was Manny with ad fraud.
Manny with ad fraud.
Yeah.
You want to hit that real quick?
Yeah, well, I don't want to call it near and dear to my heart, but certainly something I had a lot of conversations about, more so prior to starting Digible. But, as we talk pandemics, and not to make light of it, I'm just saying it's become almost such in the ad space world or the ad tech world, meaning that there's a lot of fraudulent traffic, and it's not to scare or alarm people or, have anyone overreact, we'll say. But with all the digital advertising out there, and I'm sure people are familiar just, with bots at large, but a lot of the advertising and traffic that you're seeing isn't always legit, big shock, right? So we had the, good fortune of coming across Manny Quintez, who, has been a CTO in many of his previous roles, and I think now founder, president at Rebel.ai. Anyways, so yeah, we had a great conversation with him about kind of where things stand there with things like programmatic and display in particular is where we really concentrated, as the industry seems to be adopting that faster and faster. And what are some good tips, specifically for both agencies but clients as well on how to be more mindful and try to kind of de-risk some of the ad fraud up front. So I thought it was super fascinating. There's definitely some parts of that not everyone's going to fully grasp because Manny can get in the weeds pretty quickly, but there's also, I think, some really good takeaways.
He almost seemed uncomfortable trying to keep it so high level. He's like, how do I keep it high level?
Yeah, not easy. Yeah.
But just for context, he was saying somewhere around 20 to 30% of all traffic online is for ad buys is fraudulent. He said it depends on the agency and the tech stack that you're working with, but It could be as low as 10% for some of the Fortune 500 brands that he's worked for. That's what he's seen, but it could be as bad as 90% for some of the SMBs that he's worked with. So he just usually earmarks 20 or 30% of ad traffic being fraudulent. And so, yeah, we barely got into the conversation. So we'll probably have him back on another, it may be webinar or at our own event. Because I just think he's got some really good information that people should be aware about.
Yeah, and one that was a late reschedule, and hopefully, you know, don't mind a bit of a plug as far as some of the content we have coming, because this isn't directly related to COVID, which obviously this webinar is, but we'll also be getting pretty in the weeds on how marketers are defining comps these days compared with operators. You know, has the bridge, you know, or the gap, we should say, closed, or is it still, you know, I see it one way and you guys see it the other? So that should be fun too. But maybe wrapping up, as you say, you often try to take the cherry. So I don't know if you're going to put one on top of this.
No, you cherry. I never cherry.
Right. No, I know.
Oh, okay.
I know. I'm saying I don't want to, like, if you're trying to get, you know, the cherry.
Put the whole bundle of cherries on top.
Yeah. Well, just specifically on this, you know, from the very first one that we launched, I couldn't help it. I was like, I want to see underneath there. I want to see, you know, at a market level. I want to see at a floor plan level. So nice that, you know, our data team, you know, helped scratch a little bit of that itch with some of the floor plan stuff. But I think that clearly is what has the most value for our clients, for the people on the podcast, is to see exactly what it looks like in their market. So as we mentioned, and we did offer up, Fiona, our marketing technology, has really all this data at a local, you know, sub-local level. Yeah, that's still there and available, but what we're planning, and I don't want to overpromise here, but our data science team is wanting to stand up kind of, you know, a COVID map, similar to what we've all been seeing, you know, on various news sites on which states are trending where, but that we would then have a real-time map that you could just scroll over interactively and look at that stuff. So that's in the works, you know, hurry up and wait, but hopefully, you know, I'd say maybe in 90 days, you know, by the end of the quarter, we'll have something together. And that's going to be important timing too, as a lot of people are predicting, obviously, resurgence, you know, when we get into the fall.
Mm-hmm. Cool. All right. Well, thanks everybody for staying tuned. If you have any follow-ups for us, hit us on email, David at Digible, Reed at Digible. We'll get back to you. Thanks.